Okay class, today we are going to discuss about accounts of not-for-profit concern. Today I would like to draw your attention towards my topic. The topic is accounts of not-for-profit concern. Basically there are two types of organizations existing in India, or you can say any part of the world. There are two types of organization. One is profit making organization and second one is a non-profit making organization. Profit making organization means those who are engaged in trading of goods and services, and not for profit making organization is also engaged in various types of services. But today we are basically here to discuss about not-for-profit concern. But first of all, we must understand what is the difference between trading concern and non-trading concern. Means profitable organization and not profitable organization. Profitable organization means their basic motive is to earn profit. Profitable organizations' basic aim is to earn profit, but not for profit making organizations. Main intention is not to make profit. Their main intention is to provide services to the society. They are not going to make profit. They are here to provide us services. That's why they are called not for profit making organizations. Now we have so many examples of not for profit making organizations, like we have schools and colleges, charitable trusts, hospitals. They are all engaged in providing services. Their main motive is to provide services to us. Now, since they are not for profit making organization, their main intention is not to make profit. But there are some organizations whose main intention are to make profit. That's why they are called trading concern or profitable organization. They prepare trial balance and some on the basis of some adjustment. They will have only basically trial balance and some adjustment, and on the basis of that we have to prepare trading account, profit and loss account, and partnership capital account if it's partnership business, and then finally we need to prepare balance sheet. But if we are having a business like not for profit organization, they prepare only receipt and payment account. They prepare only receipt and payment account, and on the basis of receipt and payment account they are going to prepare their balance sheet to show the financial position of the particular concern. Now let's have a look how they prepare receipt and payment account. Now here we have receipt and payment account of accounts of not-for-profit concern. They basically prepare receipt and payment account where on the debit side we have receipt side and where on the credit side we have payment. Now receipt and payment account is nothing but it is a real account, and we are already aware with the formula of real account means what? Real account means debit what comes in, credit what goes out. In the same way, receipt and payment account, they are going to record whatever they are going to receive in the business, they are going to record it on the receipt side, and whatever is going outside of the organization, they are going to record it on the credit side. So receipt and payment account is nothing but it's your real account. Debit what comes in, credit what goes out. Now we, on the basis of receipt and payment, only in this type of problem we will be given only a receipt and payment account, and some there might be some balance sheet will be given in the problem itself, and on the basis of that we have to convert it into income and expenditure account, and we have to also prepare balance sheet. So not for profit concern organization, we have to first prepare income and expenditure account, and second thing is our balance sheet. Now what do you mean by income and expenditure account? So income and expenditure account is nothing but is a nominal account, and what our nominal account rule says that debit all expense and losses, credit all income gains and profit. And same thing we have to follow here in our income and expenditure account. All expenditure will be recorded on the debit side, and whatever income, gains and profit we are having, it's going to be recorded on the credit side. Now, I have already informed you about receipt and payment side and income and expenditure account. So I think you have understood that receipt and payment account is a real account. It means debit what comes in, credit what goes out. They follow. Now for income and expenditure account, they follow nominal account rule. Debit all expenses and losses, credit all income, gains and profit. Now, before I delve into fascinating details of accounts of not-for-profit concern, I would like to draw your attention about capital expenditure, capital receipt, revenue expenditure and revenue receipt. If you want to solve, if you want to learn how to prepare income and expenditure account and balance sheet with the help of receipt and payment account and some given adjustment, then you must understand what do you mean by capital expenditure, capital receipt, revenue expenditure and revenue receipt. Now I am going to describe the details. What do you mean by capital expenditure? Capital expenditure means non-recurring in nature. Now the question will arise that non-recurring in nature means it is going to be used for a long-term purpose, and non-recurring means it's not going to be repeated in a year. So capital expenditure, what could be the example of capital expenditure? Suppose if we have purchased land, are we going to purchase land every now and then in a year? No. So land and building will be our capital expenditure. Motor car, all these are example of capital expenditure. It is going to be used for a long term period in the business. Now we have capital receipt. If I have purchased land and building, or if I have purchased motor car, then it is known as capital expenditure. But what if I sold land and building? Then I am going to receive money. That's why it is called receipt, and this money is our capital receipt. So if we have sold our assets which we are going to use for a longer period of time, and if we are making or receiving money after selling those particular assets, then it is known as capital receipt. So capital receipt is non-recurring in nature, and capital expenditure is also non-recurring in nature. The difference is that if we purchase assets, then we have to pay. Then it is known as capital expenditure, and in the same way, if we sell capital asset, then we are going to receive money. That's why it is known as capital receipt. We are not going to sell every now and then land and building, motor car in a year. So it's not going to be repeated. That's why it is called capital receipt. Now same thing, after understanding capital expenditure and capital receipt, now we have to concentrate on revenue receipt and revenue expenditure. If you have understood what do you mean by capital expenditure and what do you mean by capital receipt, then you must understand the meaning of revenue expenditure. Revenue expenditure means recurring in nature, which is going to be repeated in a year. Revenue expenditure recurring in nature for a short term period. Like if I am paying salary to my employee, then there is a possibility that I might be paying salary more than I will be paying salary a lot of time to my employees. It is not necessary that I will pay salary for only 1 month. I have to pay each and every month. So this transaction will be repeated, and any transaction is repeated, it is known as recurring. And since we have to pay money, or we are paying money from our organization, so it is repeated expenditure, so it is called revenue expenditure. Now next thing, we have revenue receipt. There is a possibility that we might get revenue receipt. How can we get revenue receipt? If I have invested money in share market, there is a possibility that I might be getting dividend, and that dividend is known as recurring in nature. There is a possibility that I am going to receive interest on a regular period. There is a possibility that if I am working somewhere, then I might be receiving money. Then if I am receiving salary, there is a possibility that I might be receiving money regularly. So it is recurring in nature, it is repeated in nature, so it is known as revenue received. But if I am paying salary to my employees, then it will be known as revenue expenditure. So for the time being, I am assuming that you have understood the meaning of capital expenditure, capital receipt, revenue expenditure and revenue receipt. Now, on the if we have understood capital, revenue, then we can go for a receipt and payment account. Now, how to deal with receipt and payment account? I'll inform you only two things, that on the debit side, means receipt side, we have capital receipt and revenue receipt. On the receipt side, we will be given only two items. One will be capital receipt and second one will be revenue receipt. And on the payment side, we will be given only capital expenditure or revenue expenditure. So capital receipt and revenue receipt is recorded on the receipt side, and capital expenditure and revenue expenditure is recorded on the payment side. Now, on the basis of this, we have to prepare first income and expenditure account, and then we have to prepare our balance sheet. Now, let me tell you one thing very clearly. We have understood the meaning of income and expenditure account. Income and expenditure account means nominal account. Debit all expense and losses, credit all income, gains and profit. So, if we are receiving revenue expenditure, then it's going to be recorded on the expenditure side. Means, if we are paying revenue expenditure, then all revenue expenditure will be recorded on the expenditure side. But if we are receiving revenue receipt, then it will be recorded on the income side of our income and expenditure account. It means that if I am receiving salary, so salary is receipt is my income. So it will, and this one is our revenue receipt, which is going to be received repeatedly. So it will be recorded on the credit side. Right? Now, if I am paying wages or if I am paying interest, then it is my revenue expenditure. Then it is going to be recorded on the expenditure side. Now, what about capital receipt and what about capital expenditure? Now we have capital receipt. Capital receipt will be recorded on the liability side of our balance sheet. So let me very clear. Revenue expenditure is recorded on the expenditure side of income and expenditure account, and revenue receipt is recorded on the credit side of our income and expenditure account. Now we have capital receipt, which is going to be received recorded on the liability side, and we have capital expenditure, which is going to be recorded on the asset side. So let me very clear that here in receipt and payment account we have debit, credit. Left hand side represent debit side, right hand side represent credit side. In the same way, in our income and expenditure account, left hand side represent debit side and right hand side represent credit side. But what about balance sheet? Balance sheet is not an account. Balance sheet is a statement, not an account. Look here, in our receipt and payment account, I have written debit on the left hand side and credit on the right hand side. In the same way, in our income and expenditure account, we have recorded debit side on the left hand side and credit we have written on the credit side. But in our balance sheet, we have not written debit and credit. The thing is that balance sheet is a statement, not an account. Now, let me tell you one thing very clearly, that when you used to prepare or when we used to prepare our final account, then what accounts we were supposed to prepare. We used to prepare trading account, profit and loss account, and then we get our balance sheet. After closing trading account, we get balancing figure, either gross profit or gross loss, and that is going to be transferred to our profit and loss account. And whatever balancing figure we get on the debit side of our profit and loss account, that is known as gross profit, and if we get balancing figure on the credit side of profit and loss account, that is known as gross loss. That is known as gross loss. So gross profit is recorded, or gross profit is transferred to the trading account. Gross profit is I'm making mistake. Gross profit is transferred to our profit and loss account, and gross loss is also transferred to our profit and loss account. Now after closing our profit and loss account, if we get balancing figure on the debit side, then whatever balancing figure we get, that is called net profit. But if we get balancing figure on the credit side, then we get net loss. And net profit or net loss is transferred to our balance sheet. In the same way, here we have to first close our income and expenditure account. When we close our income and expenditure account, suppose if my income side is greater than my expenditure side, then I might be getting balancing figure on the debit side, right? If my income side is greater than expenditure side, then I might be getting balancing figure on the debit side, that is known as surplus. That is known as surplus. Here we do not say net profit or net loss. And what do you mean by surplus? Surplus means excess of income over expenditure. When income is more than expenditure, then we get surplus. But there is a possibility that we might get deficit also. If our expenditure is more than income, then there is a possibility that we might be getting balancing figure on the credit side. And if we get balancing figure on the credit side, that is going to be known as deficit. Deficit means what? In bracket I have written that excess of expenditure over income. Excess of expenditure over income means what? If our expenditure is more than income, if I am earning 10 rupees and I am spending 100 rupees, then I am getting deficit of 90 rupees. But there is a possibility that I might be earning 100 rupees, but my total expenditure will be only 80 rupees. Then my surplus will be only 20 rupees. Now, what after closing surplus and deficit? Suppose if we get surplus, so surplus balancing figure we are getting on the debit side, it will be transferred to, or it will, since we have got balancing figure on the debit side, so we are already aware with the accounting principles that if first one is debited, then second one must be credited. Since we have got balancing figure on the debit side, so it will be transferred to the credit side. And we are aware that liabilities represent credit side. So this one is debit side, it will be transferred to liability side, then surplus will be added to our capital fund. But if we get balancing figure on the deficit side, it means that we have got balancing figure on the credit side. Then if we have got balancing figure on the credit side, then it must be transferred to debit side, but we are not recording it on the debit side. Instead of recording debit side, we are going to deduct it from liability side. Whether you record it on the asset side or whether you deduct it from the liability side, the ultimate effect will be debit. If we are deducting from liability side, it means that it is a debit effect. Now, after getting surplus and deficit, we need to close our balance sheet, and finally we will be getting our balance sheet tally. Now, let me tell you very clearly, do you know the actual meaning of assets? What do you mean by assets? Let me tell you three things very clearly. All kinds of properties in the business are known as assets. All kinds of properties. All kinds of properties means what? Land and building, plant and machinery, furniture, vehicles, motor vehicles, all are equipment, all are my properties. So it's going to be treated as asset. There is a possibility that we may have tangible assets and intangible assets. Intangible assets like copyright, patent, trademark, goodwill. So first definition for assets is all kinds of properties in the business is known as asset. And second thing is that anything receivable in future is known as asset. If we are going to receive anything in future, then it's going to be considered assets for us. For example, if I have to receive money from you, suppose let's say 10 lakh rupees, then 10 lakh is receivable for me, then it is known as asset. Like bills receivable, debtor, they are example of anything we are going to receive in future. Now third definition we have for assets is known as anything paid in advance is also known as asset. If we have paid advance, then it is known as asset. Suppose students are paid advance to the college in the form of fee, then for students they are going to consider it as asset. But now we have to concentrate on the liability side. Like asset side, there are three definitions for liabilities. First one, anything received in advance is known as liabilities. Suppose if we have received money from a student in advance, then for college it is liabilities. Now second one, anything payable is known as liability. Suppose if we have to pay some money in future, then it's going to be considered as liability. And now third definition we have liabilities, all types of loan taken for the business. So now I will tell you that on the basis of receipt and payment account, we have to convert with our income and expenditure account, and whenever we prepare income and expenditure account, either we will be getting surplus or deficit. If we get surplus, then it will be added to capital fund, and if we get deficit, then it will be deducted from our capital fund, and ultimately balance sheet will be tallied. So that's all.